All right, I think we can get started. As people join, they will get us in the middle. Welcome to you, colleagues, for joining us at this webinar, which is being hosted by the IAA Banking Virtual Forum. We always hold these webinars so that we can share information, some learnings, and for CPD purposes. Let's get into it. I will start by introducing myself, and then I will hand over to Nancy Kelly, who will take us through some housekeeping rules, and then I'll come back and introduce Stephen. As for myself, most of you would already know me. My name is Michael Tshareva. I am an actuary, being a fellow of the Actuarial Society of South Africa and a fellow of the Institute and Faculty of Actuaries. I've been the chair of the Banking Virtual Forum, I think since 2016 up to now. And we have been holding these webinars as we have been spreading the practice or the increasing practice or involvement of actuaries in banking. And this webinar is one of those where we are going to be talking about ICAAP. Now with this, I would like to hand over to Nancy. Nancy is from the IAA, who will be helping us with this webinar. And then I'll come and introduce Stephen so that we can get into it. Thank you very much.
Hello and welcome, everyone. Just a few housekeeping notes before we begin. Just to let you know that the verbal capabilities have been turned off. However, as we go through the presentation and discussions, you can click on the Q&A icon at the bottom center of your screen and submit questions as we go along. And a copy of the YouTube recording along with the presentation will be made available on the IAA website within the next couple of days. And you will find them under the past events library on the IAA website, and the URL address is at the bottom. A quick disclaimer. Any opinions expressed in this presentation and the discussions is solely those of the authors or the presenters and do not necessarily reflect the policies or positions of the IAA or any other organization. We can begin, so I'll hand it back to Michael.
Thank you very much, Nancy. So now, as we move to introduce Stephen, who is going to talk about ICAAP. So what exactly is ICAAP? We start from there. That's internal capital adequacy assessment process. Some of you who have encountered Basel regulations or Basel II would be aware of ICAAP. And some of you who work in banks already, I assume there are a few who work in banks, you would potentially have encountered an ICAAP framework. So this ICAAP is a very important framework within banking institutions, where banks have to first understand, their operating environments, and they have to clearly define and understand their business model. It also involves you understanding the risks that a bank faces, where you have to undertake a material risk assessment. And you also have to understand the risk appetite of a bank set by the board, so that you can set risk limits and any other limits that are required. ICAAP also involves capital planning and budgeting, and typically you have to undertake an enterprise-wide stress testing exercise for you to then understand the full ICAAP process and the capital that you need to set aside. And that is what Stephen is going to talk about from a practical perspective. Now, who is Stephen? Well, let's move to introduce Stephen, and then I'll hand over to Stephen. I personally have known Stephen Claxton for just more than 10 years, probably around 10 years. He's an actuary, and he's currently head of Treasury and Risk Vertical at FIS Global in the Asia Pacific regions. And he's based in Bangkok, Thailand. Now, just to give a bit of more background about Stephen, Stephen has more than 22 years of banking experience, and he's formerly a partner at KPMG. And he accumulated most of his experience across the Asia Pacific and Lower Gulf regions. He has extensive experience in the areas of risk measurement. That includes stress testing and this ICAAP that we are talking about, where stress testing is actually a subset of it. And also regulation. He, most importantly, at least for me, he assisted the Actuarial Society of South Africa some time ago, working alongside me with the development of the banking fellowship subject. And he is actually also a contributing member of the IAA Banking Virtual Forum. So Stephen has been with us, a very highly experienced banking actuary. Stephen, with that, I would like to hand over to you and we can take it forward. Thank you very much.
Perfect. Well, firstly, thank you for the International Actuarial invitation, speaking today, and the role that it plays in terms of supporting the brand of actuaries. So maybe let me start by providing an overview of today's topic, an actuarial practice guide on ICAAP. So the structure of my presentation is as follows. I'll start by addressing the question, why are we talking about ICAAP? Those more experienced actuaries in the audience may think there's nothing new, so what is there to really discuss? After which, for the lesser experienced actuaries in the audience, what I'll do is outline the core requirements covering regulatory standards and provide an overview of some of the guidance notes relating to those regulatory standards. Then finally, what I'll do is walk through some of the building blocks as Mike outlined and give you my view on them. So without further ado, let's start by addressing the question of why ICAAP. So Nancy, if you could just jump to page 6, that would be great. So in my current role, I cover Asia Pacific and the Middle East regions across the banking sector, which I'm sure, as you can imagine, exposes me to a very broad range of operating environments, and which may in part explain the reason why I believe ICAAP is such an important topic, and hence the reason we're discussing it today. So I start by looking at the UAE region, for example, which is currently undergoing regulatory modernization programs where banks are looking to adopt internal rating-based approach to credit risk, looking at Pillar 2 single name, economic capital models, as opposed to prescriptive capital functions, which is essentially punitive from a capital perspective. So in the UAE region, the regulator is pushing them to modernize, and obviously the importance of the ICAAP from a Pillar 2 perspective is increasingly important. In the Australian market, both the regulatory and expectations are ever increasing in relation to the stress testing, which is pushing the internal stress testing teams to the limits of their capacities. This year alone, in addition to the ad hoc stress testing, which they're doing, as the unfolding geopolitical events, relating to the imposition of tariffs continue to occur, they have to also generate 2 climate risk stress tests looking at physical and then transitional risks of climate. APRA is also running a system-wide stress test looking at potential contagion across the banking and the insurance sectors and the pension funds. If I then go into the Korean market, next month I'm going to be running a roadshow in Seoul across a number of systemically important banks on the topic of balance sheet optimization, due to a number of environmental factors which are adversely impacting the business models. For example, the return on equity has fallen below the group's estimated cost of equity for the last 3 out of the 5 years. The shareholders' returns are significantly lower when you compare that to their international competitors. For example, the price-to-book ratio of the average Korean bank is only approximately 50%. And there's been significant FX translation losses due to the devaluation of the Korean won, due to some of the political instability at the end of last year. So the slide that you're currently viewing is one of the introductory slides, which I'm going to be using to communicate to the banks in Korea around how to deliver a balance sheet optimization process, which on the slide you can see comprises of risk and macro factors, alternatively stated as coherent economic scenario generation, looking at front book models, balance sheet growth models, looking at dynamic balance sheet, allocation models across the different products, the different sectors which the bank may be lending to or trading in certain instruments, behavioral models across assets. So you can think of maybe IFRS 9 credit impairment models for your lending perspective. If you're looking at the liability structure, this could be risk-sensitive haircuts associated with repos, for example, and off-balance sheet exposures relating to potential future exposures relating to derivative positions, for example. Now, at this stage, you might be asking yourself, why is Stephen telling me all this? Well, look, the answer to that question is all of these components around economic capital, enterprise-wide stress testing, scenario generation, behavioral models are all critical inputs into the bank's ICAAP. So hence the reason why I'm talking about them. So Nancy, if we could just go to the next slide, please. So turning my attention away from some of the external market factors, explaining why I believe focusing on ICAAP is important, and looking at some of the more internal bank-specific factors. Another reason why I'm focusing on the ICAAP is due to the high level of operational inefficiencies associated with the ICAAP. In my experience working with banks across Asia Pacific and the Gulf state, a bank which is running only say 2 to 5 scenarios across a planning horizon, which may vary between 3 to 5 years, depending on your geography. This takes approximately 12 to 16 weeks to run the ICAAP from start to finish. So you can see that in the environment that we're currently running in, where there's constant change, this really challenges the ability for ICAAP to be integrated into the way in which the senior management is running its actual business model. So the process flow, which I'm showing on the screen, is a diagram from a real life situation of an Asian bank based on Singapore. And considering the skills and the experience that an actuary brings to the table, I see an opportunity for the actuarial profession to bridge some of these inefficiencies which are embedded in the process. Finally, if you want to drill into a little bit more detail on the ICAAP process, what I'm showing on the left-hand side of the screen is essentially an ICAAP practice guide, which goes into a lot more detail in terms of the building blocks and some of the real-world practices, given the time constraint for today. So let's jump into some of the core regulatory drivers behind the ICAAP. So Nancy, if you could just jump to slide 9, please, that would be great. So let's start with the core global regulatory requirement, which can be found in the Basel Consolidated Framework, namely the Supervisory Review Process, or SRP, for example, via the link which is displayed on the bottom of the screen. So at a high level, the Pillar 2 supervisory process ensures that a bank has adequate capital and liquidity to support the risks associated with their business model, especially with respect to some of the risks which are not captured in Pillar 1, a process and encourages effective risk management. So you'll see that this objective is essentially supported via 4 principles, as stated on the slide. Now, the principle which we're specifically interested with regards to ICAAP is Principle 1. So Principle 1 essentially states that banks should have a process for assessing their overall capital adequacy in relation to their risk profile and strategy, and maintaining those capital levels. Now, given the relatively high-level nature of the statement, it helps in practice to then transform this statement into some of the logical building blocks, which can then be assigned to suitably qualified, experienced professionals to deliver against those requirements. Those logical building blocks of the ICAAP are displayed on the right-hand side. As you will see, so the business model, so the strategy and the operating environment, a material risk assessment based on the bank's business model, strategy and operating environment, a risk appetite statement, which is aimed at quantifying an acceptable level of risk and quantifying those thresholds for preemptive action taking to prevent a more stressed scenario from impacting on the bank's balance sheet. A capital plan, which is based on projecting organic capital supply via returned earnings and capital demand associated with those material risks which have already identified as potential impacts in terms of the viability of the institution. And then finally, sort of the management actions which can be taken to resolve potential adverse scenario which may occur over your forecast horizon. If we can just go to the next slide, Nancy, please. So in practice, the ICAAP is driven by local regulatory guidance, which varies significantly. I recently spent 2 days in Doha with the Qatari Central Bank, discussing with them some feedback as provided by the IMF in relation to the development of a proactive intervention framework, where the ICAAP is a significant input to that process. Now, during my time with the central bank, I commented on the level of prescription embedded within their ICAAP guidance note, as displayed on the right-hand side of the chart when compared to APRA. So QCB provides 52 pages versus 21 from APRA. Now, my summarized feedback to the central bank was, whilst it makes sense to provide a high level of prescription and guidance to smaller, less complex banks, institutions such as QNB, which is the largest bank within the Gulf region, and is approximately 54% of the total banking assets of the domestic Qatari sector, you should allow them to develop their own approach, i.e. less prescription, to acknowledge the nuances associated with their business model and essentially their role in driving the local economy. So whilst there is a global standard, you're going to have a level of prescription and a level of guidance which comes in through the actual local regulator. Nancy, if we could just go to the next slide, please. So the final slide in terms of covering the core requirements, as the ICAAP is a restricted document and not for public disclosure, a lot of people who are working, consulting to the bank may not have seen a real world ICAAP document. So to close this gap, what I'm displaying on the left-hand side, I would describe as the general structure of an ICAAP based on the banks that I've worked for and consulted to across those geographies, which I just previously mentioned. As you'd naturally expect, based on what I was just talking about, my experience with the Qatari Central Bank, you do see a range of natural practices. In the case of the Canadian banking sector, the local regulator, for example, has taken the step of actually prescribing a template for small and simple banks so that they can essentially address the requirements, because typically in a smaller bank, there may not be the capabilities and the capacity to essentially cover all of the complexities associated with the ICAAP. So the regulator plays that role of bridging the gap. Okay, so hopefully having provided you with the reasons why I'm discussing ICAAP and the building blocks, let me spend some specific time looking at some of the key features associated with those individual building blocks. So Nancy, if we could just move to slide 13, that'd be great. Okay, so the first building block that I'll be discussing is essentially the business model and the operating environment. So look, in my experience, the fundamental question that needs to be answered when you're essentially working within the context of ICAAP is, will the board be able to distribute its forecasted dividend payout to ordinary shareholders whilst meeting its regulatory constraints across capital, liquidity, funding, and leverage in light of the business model within the current operating environment? Were those earnings which are used to actually pay the dividend through from the provision of credit facilities via funded or contingent credit products to the real components of the domestic economy and potentially international markets, depending on the size and complexity of the institution, participating in the capital markets via the underwriting of new equity or debt issuance, for example, or proprietary trading, or market making, for example, and where those regulatory constraints across capital, liquidity, funding, and leverage are driven by the type of business model, as displayed on the bottom hand of the slide. You can maybe think of the operating environment as being characterized by a couple of dimensions. The first dimension being the macroeconomic component, as I previously mentioned, sort of the coherent economic scenario generation across your swap curves, across inflation, exchange rates, equity components, credit spreads, and other components of the macroeconomic environment, which are going to drive the banking book, the lending, and the trading book, and the fee and commission income of the institution. Also need as part of the operating environment to consider the geopolitical situation. So as we were mentioning around the imposition of barriers to the movement of goods and services, such as tariffs and the imposition of sanctions. This is a part of the supply chain finance that the bank provides in its trade finance portfolio. Then the final dimension when generating that kind of operating environment is to look at the reputation, the regulatory environment. So one of the newer nuances around ICAAP is looking at the integration of environmental and sustainability and governance into the bank's ICAAP process. So looking at transitional risk, for example, so decarbonization strategies and how that's going to impact on the bank's balance sheet. Also looking at how potentially acute physical events could impact on the bank's balance sheet. So one of the newer operating environments which banks need to account for as part of their ICAAP relates to the topic around climate, for example. So if we could just go to the next page, Nancy, that'd be great. So the second and third building block, which I mentioned around material risk assessment and risk appetite, as displayed on the left-hand side of the slide, that is a starting point in terms of the material risk assessment. So it's aimed to define the strategic goals of the bank in light of that business model and that operating environment I was just mentioning, whether it's a trading bank, whether it's a lending bank, whether it's generating fees and commissions through maybe its wealth management business. So some of the potential strategic goals that you might see as part of an ICAAP would be looking at potentially expanding its cross-border business, for example. It could be looking to diversify away the bank's net interest income through sort of commissions and fees, for example. Obviously, with the sort of rollout of artificial intelligence, looking at spearheading IT transformation around replacing some of the legacy systems. So some of those are sort of key strategic goals. Now, off the back of those kind of strategic goals that I've just outlined, you can then start to think about some of the material risk assessment process. So if you're starting to sort of go cross-border, the potential implications of structural foreign exchange risk relating to those investments overseas, strategic risk, so inappropriate business plan, wrong timing, wrong segment associated with that diversification of your net interest income, for example, via the release of new products. And then on the topic of sort of artificial intelligence and spearheading sort of IT transformation, you can think about operational risk, for example. So the loss resulting from inadequate, failed process internally. Now, if I sort of step back from those specific examples, what I'm showing you on the current slide is essentially a real-world example of a UK bank which identified 12 specific material risks as part of its material risk assessment. Now, what you can see on this image from the bank's perspective, in addition to those regulatory prescribed Pillar 1 risks, such as credit risk, market risk, and operational risk, the bank effectively identified another 9 material risks, which range from country risk, so looking at covering sovereign default risk, transfer and convertibility risk associated with the potential imposition of foreign currency being moved overseas, and in terms of that broader social, legal, and military related impacts, such as what you're seeing in for example, in Europe and parts of the Middle East, for example. Another risk that was identified is looking at what's known as the interest rate in the banking book risk, or IRRBB, relating to the economic value of the banking book instruments, such as the deposits and lending and some of the off-balance sheet exposures, such as guarantees, for example, and the net interest income across a range of different yield curve scenarios in terms of the repricing, the basis risk, basis between funding and potentially lending, and then also embedded optionalities in terms of the funding instruments and the lending instruments. Furthermore, on the slide, what you'll see is a sort of a risk appetite statement intersects with that material risk assessment process. And the additional criteria to specify that risk appetite, which talks about the maintenance of adequate level and quality of capital to ensure solvency on a going concern basis, delivering stable earnings growth in line with the system growth, access to efficient and stable funding to maximize your net interest income, and then the maintenance of a institution's reputation as measured via an external credit rating. So that provides them with access to efficient and stable funding. So let's maybe drill into a little bit more detail as to what a risk appetite statement could look like. So Nancy, if you could just go to the next slide, please. So I've chosen to illustrate the credit risk dimension, given that the majority of banks, credit risk is the most material risk from a capital perspective. One of the key features contained within the statements are the relative order of importance, or the subweights. For example, the non-performing loan or NPL ratio relative to country risk is judged 5 times more important based on this specific bank's business model and operating environment. And the alerts, the sort of the limit which triggers their management actions, where a threshold is essentially quantified by the bank's stress testing, which is typically based on a mild forward-looking scenario, such as the bank's inability to take preemptive action before that situation deteriorates and may need to trigger a recovery plan. So if we can just go to the next slide, slide 16, please. So as I mentioned during the why ICAAP section, the execution of the ICAAP requires inputs from group economics, finance, risk, and treasury. And the specific roles are color coordinated on the current slide within the context of capital planning, where the aim is to essentially derive the capital buffer as displayed on the lower part of the slide. Now, the capital plan essentially forecasts assets and liabilities, income and expense associated with all the business lines. So whether you're looking at your commodity sector from a lending perspective, whether you're looking at proprietary trading, whether you're looking at underwriting fees, it looks at all of the changes in those assets, liabilities, and income over let's call it the funding horizon, which, as I say, is typically in parts of Asia Pacific is generally that 3-year horizon, but it could be more likely 5 years when you start dealing with some of the European banks. So the strategy plan covers essentially the bank's medium to long-term strategic goals, customers and marketing positions, and the competitive environment analysis, in line with the business, development targets. Now, the capital plan is developed by the CFO and is subject to board approval. Senior management is responsible for reviewing and implementing the progress against targets, discussing status at board meetings, and reviewing the business performance in light of those operating environments and potentially modifying its sort of strategic and operational adjustments, as we were just highlighting before in terms of the geopolitical environment, which is rapidly changing, how they might potentially want to update the forecast in light of emerging experience, right? So look, at a minimum basis, this is performed on an annual basis. Now, from a capital demand perspective or the material risk perspective, which was what we were just discussing before, the bank must account for those Pillar 1 risks, as I previously mentioned, plus the additional components which might need modifying due to deficiencies in terms of Pillar 1 measurement model, and then also balance sheet growth, and then the transition in terms of that risk profile based on the scenario. So let me then drill into a little bit more specific detail on the next slide. So if you could just go to the next slide, Nancy. So on the current slide, what I'm displaying is in addition to the Pillar 1 risks, which I just required additional modification from a capital demand perspective. What I'll do is give you some illustration with regards to the credit component. So the types of modifications that would be required to the credit risk component would relate to portfolio granularity. So this relates to the exchangeability of defaults and single name concentration risk. So in the example of let's call it a wholesale or a corporate portfolio, you may have significant concentration in terms of a lending, like a large counterparty, whereas in the case of retail, you generally have a more homogeneous portfolio. So understanding how that non-exchangeability of defaults impacts in terms of your capital component, that's one adjustment which is required as part of your ICAAP. looking at potential adverse correlation associated with your credit component. So you might see certain sectors where there's an increase in the likelihood of default, which could then be correlated adversely with the collateral, which is supporting that position. So you then have an incremental uplift in terms of your potential loss. In a Pillar 1 context, the capital is set based on the value at risk measure, which in the case of a skewed distribution is incoherent in the sense that it doesn't fully allocate the capital. So in an ICAAP context, when you look at the modifications, typically banks would use an expected shortfall measure. Another component which is required as part of your Pillar 2 component modification is around potential different solvency level. So the Pillar 1 capital component is explicitly pegged to a 99.9% loss point on the curve, which, you know, Basel sort of says it essentially equivalent to a BBB investment grade rating. Now, if you're operating in an environment where your country, your local sovereign rating is a AAA, for example, you might find that the banks are targeting, say, a AA minus solvency, which would then mean them looking at a 99.97 solvency perspective as opposed to the 99.9 in Pillar 1, for example. And then, as I said, the final component, Pillar 1, is based on a static balance sheet, as opposed to in Pillar 2, you need to account for that front book or your additional components coming onto your balance sheet and the incremental capital that's required, both from a growth perspective and a potential risk perspective. So hopefully I've illustrated some of the sort of core principles around that capital planning component. So let me turn my attention now to more of the stress testing section. But Nancy, if you could just go to the next slide. So on this current slide, what I'm showing you are the core components of the stress testing framework. So on the upper left-hand side of the slide, I'm displaying a stylistic way in which a domestic economy can be represented to capture those operating environment features which I was describing in a couple of slides ago. Now, that operating environment can then be essentially used to simulate potential capital and liquidity stress scenarios via the first round of sort of counterparty defaults and losses, and then filtering through into funding and liquidity restrictions, as you'll see on the schematic on the right-hand side of the slide. Then finally, the quantum of those scenarios is essentially linked to the bank's financial statements via what you would refer to as satellite models, which I'm displaying on the lower left-hand side of the screen. Now, obviously, I can't display, you know, client-specific satellite models, which I've worked on. So what I've chosen to do is essentially insert the structural equations, which you'll see in the Bank of England's Ramsey top-down stress testing model. Now, given the limitation of today's presentation, I don't have time to drill into all the specifics of coherent economic scenario generation, the schematic displayed on the right-hand side of the screen. But I mean, I would point members on the actual call to look at, you know, the potential, you know, stress testing documents and the scenario generation references that I've displayed on the slide for additional details. Now, if you go to the final building block, the next slide, Nancy. So this final slide talks to the building block relating to what's known as the management actions. Now, these are triggered essentially in the event of a forecasted funding deficiency or a capital deficiency. Now, as mentioned earlier in the presentation, I spent 2 days with the Qatari Central Bank discussing the feedback from the IMF with regards to that proactive intervention framework and ICAAP and the linkage with recovery and resolution planning. Now, the image, which you'll see on the left-hand side of the slide, graphically illustrates that link. So where the green region effectively represents the ICAAP, the orange region essentially represents the recovery plan, and where these regions are effectively divided by the early warning signals and the limits. As I mentioned previously, within the context of credit, these are the sort of the triggers to take you from your let's call it business as usual region into the, proactive, situation deteriorating. And if it continues without that management action being in place, effectively going into a recovery plan. So sort of turning my attention to, some of the potential management actions, these typically are identified to, mitigate or, essentially mitigate the outcomes of that funding or, capital deficiency. So the first type of option that you could look at is, raising of additional capital or getting capital from a sort of a group source, for example. So raising additional common equity or additional tier 1 or tier 2 capital, depending on the type of scenario you're looking at. You can look at balance sheet reductions and changes in the business mix, for example. So selling off some potential institutional loans or partial disposal of some of the non-core retail lending portfolios, for example. Expense reductions. This could take on deferral of non-strategic processes, or let's use it outsourcing or potential headcount reduction, for example. Capital repatriation via onshore subsidiaries or offshore subsidiaries, subject to potential free flow of capital across borders. And then finally, around sort of the more sort of, let's call it strategic optimization of data capture and calculation models. So this could involve removing of margins of conservatism, which may be embedded within your ICAAP process, or over sort of, let's call it in the case of, say, IFRS 9 or your provision charge, it could be removal of certain management adjustments. So essentially stripping out what I would describe as margins of conservatism to then essentially tidy up the balance sheet. So let me spend a quick minute, if we could just go on to the final slide, Nancy. So before we get into the Q&A, as I say, why do I sort of see ICAAP for, the actuarial profession? So that, as I was saying before, I see the ICAAP as a precursor to more strategic and interesting topics such as balance sheet optimization as the one that I outlined before. I think the ability for actuaries to work across a broad set of stakeholders such as Treasury, who's going to be focused on your funding plan, working with finance, who's building out your pro forma financial statements and doing the accounting side, and then the group risk function, which is looking at the sort of the capital demand and some of the stress testing components. Actuaries have the sort of the training, the skills, and the experience to essentially provide that kind of role of across that, and this is achieved through our core technical skills, the continuing professional development and participating in forums such as this, where you can share experiences in terms of those better practices and what's going on in the market. Look, I think the other reason is actuaries have experience working with complex regulations and communicating those outcomes to supervisory teams in the form of the prudential regulators. So understanding data, understanding accounting, understanding regulation, and being able to marry that essentially with measurement modeling, I think is the core of actuarial profession. And the reason why I believe sort of actuaries are the best, one of the better placed professionals to fulfill this requirement. So look, hopefully that's given sufficient context to people on the call to ask questions and then understand why we're talking about it. So Mike, I'll hand to you to maybe sort of start going through some of the sort of questions.
Thank you very much, Stephen. Quite insightful. Going through this and positioning it from a practical perspective is quite useful. It's quite important because a lot of people, some of the people who are here may not have encountered this in practice. So considering all these issues is quite important. So thank you very much, Stephen. I think this is great. Right now, I'm looking at question and answer, and I don't see any question and answer from the audience. But Stephen, I would have some very, interesting questions for you, so that maybe we can have a conversation as we wait for any questions from the attendees. So I would like to start firing some of those questions. Some of the issues are reflected on your slides. Some of the issues are what you said and elaborated on. So I'll start with my first question, Stephen. My first question is, in your view, why is ICAAP more than just a regulatory tick box exercise? What value does it actually bring to management decision making? And the reason I ask this question is because many people still see ICAAP as a compliance burden, but the presentation itself hints that it can drive strategy and balance sheet optimization if used properly. Or what would you say? What are your views there? Thank you.
Well, yeah, look, I mean, I would start with I think the operational inefficiencies and the disparate number of product systems across a typical bank is the barrier to why ICAAP isn't a strategic planning tool in a lot of institutions, right? So the point of why is it a tick box exercise, I think it's because of the barrier to entry. It's not that the banks and the institutions don't see the value and the benefit which essentially ICAAP can bring in terms of, let's call it sense testing, the capability of the institution to essentially deliver, earnings and dividends to its shareholders in line with the sort of the projected operating environment. I think it's really that kind of barrier to entry, the data component. So I wouldn't really frame it as conceptually banks don't see the value. I think it's more a case of that the institutions, because of potentially legacy issues, through acquisitions, through just the sort of complexities of the operating model, that they can't get to that point where they can actually generate kind of strategic benefits off the back of ICAAP. And again, it's not one size fits all, Mike. I mean, as you would know, right? I mean, larger banks are going to have greater capacity to support that, from a human resourcing perspective and also from a financial capital perspective to actually execute that. Whereas obviously more monoline, potentially small regional retail banks, are not necessarily going to be as, vested in actually driving it. So, short answer is, the barrier to entry is that operational inefficiencies.
All right. No, thank you very much, Stephen. And with that answer, you have even answered the other question I was going to ask. So I was going to ask this question where, on your slides, ICAAP requirements, you do say ICAAP requirements vary by region, by size and business model. And I was going to ask you to give examples of how ICAAP actually looks different in, say, a global bank versus a small Asian or African bank. This does help us to see where proportionality comes in and why a one-size-fits-all approach does not work. So you touched on that briefly. Is there anything else you want to add on that?
Yeah, look, I mean, I'll talk to maybe some of the experience I've had working with the Australian banking system. The Australian banking system is where you have 4 large domestically systemically important banks, and then a sort of I suppose a very sort of long tail in terms of smaller, historically some of the mutual financial institutions. So I think there's probably 3 areas where I would sort of point out the sort of the difference. I think the first one relates to the governance process, or let's call it the independent challenge of the ICAAP. So when you run an ICAAP at a larger bank, you'll find that there's far more constructive, formal and informal challenge through from your internal model validation function, the internal audit process is a lot more robust and sort of over the sort of the operational and the sort of the components of the ICAAP. Whereas then when you look into a smaller institution, you're probably going to see lesser challenge, lesser effective governance over the components of the ICAAP. The next component I'll probably point to, I think we touched on this, is around scenario generation. So, scenario generation in itself is quite a complex task, given all of the sort of the components which can, impact on a bank's net interest margin. It could impact its trading income, for example, or spike in terms of its costs, its operational costs. So that scenario generation is generally done in the large banks by its internal group economics or potentially augmented with, coherent simulation models at the larger institutions. Whereas when you then go into the smaller institutions, you tend to find that it's just, a scenario which is being provided by the regulator or sort of the central bank. So those small banks in Australia typically just, would take the scenario which is provided by APRA as part of its top-down, annual stress test. And then I think the final one, obviously, then just following through, for the use of that stress test, you wouldn't necessarily see the smaller banks, leveraging that stress test other than, for the purposes of setting internal capital, limits or internal capital targets, right? It's not as integrated into the risk appetite statement and setting and testing that you would see at the larger banks. So, in summary, those three components is what you really kind of see as a difference. So the governance, the generation scenarios, and then, basically the application of stress testing as part of the, day in, day out management of the institution. So I think that's probably where I would say. I mean, maybe just interested in, is that sort of similar to what you would see on the African continent, having not necessarily worked too much across the African continent? Is that kind of consistent with what you see over there, Mike?
Yeah, it's exactly the same. And, we always have, me and you always have this kind of conversation. Banking is very global. It's really almost, it's universal. Whatever is happening in Australia or in the Asia Pacific region, you find the same in the South African space. It's all based on, size of bank and many other factors affecting each particular institution. And so the examples you give are equally applicable, have been seen in practice. But thank you very much, Stephen, for answering that and for asking me to highlight on what happens within our African context. Now, I've got a question. I've got actually two questions that have come from the audience now. So I'll wait for my questions. If we still have time, I can still ask you more for better discussion. Now, the question here says, could you share some examples you have come across on incorporating emerging trends within the ICAAP stress test process and capital actions required?
Well, yeah, I mean, look, I think just for context, I mean, the emerging trends, if we're talking about sort of fast-moving scenarios, that tends to be more on your funding and liquidity and less or so on your capital. So if you're looking at sort of obviously, let's say, for example, a fast-moving event could be an operational risk event, which then sort of manifests in terms of the reputational damage. The types of scenarios you would consider is, looking at sort of repos of, sort of government securities to sort of potentially overcome, short-term kind of, outflow of liquidity, for example. So the sort of the nature of those fast-moving scenarios and emerging trends is generally more on your sort of your internal liquidity assessment process and probably lesser so on the ICAAP. But, the component which I was just talking about in terms of your risk appetite, those kind of settings within the context of sort of liquidity, I mean, that's really where you would sort of, put your emerging trends in there. So hopefully that addresses the question, Mike.
No, thank you very much. I think it does. So thank you very much. And we have got a next question here, which I'll probably just say a statement and then also ask for your views. Do you have any comments on challenges actuaries have in competing against other disciplines like CFA, MBA, to assume leadership roles in ICAAP, and how actuaries can demonstrate they are more capable than the other disciplines? Look, so for me, this question comes a lot. So this question applies across all the functionalities within banks where actuaries can be involved. So we have always said that we do not go there to compete with anyone. We go there knowing that we will be working in multidisciplinary teams, but we have also seen that actuaries bring a lot of value just by virtue of our training. And if some of you would start thinking about even the fact that we have got education on banking, we have got, for example, the banking fellowship that's being offered by ASA and IFOA candidates or students also take the same subject. We cover ICAAP in great depth and more than any other, because you don't find that in MBA, you don't find that in CFA. We do cover it. We actually have material. So I think it's now up to individual actuaries to go in there, showcase your skills, because the actuarial qualification, as we have always said, is a toolkit. It's a toolkit that you can then use to apply. And if we then say, taking banking as a specific practice area, all you're doing is taking your toolkit and apply it. And then obviously, because we are now teaching, we've got a banking subject that's going on, we probably even have an edge. So go in there, sell yourself, and say, this is what I can offer. That's what I can say. But let's hear from Stephen. There's another question as well, Stephen, that we will go to after you've given your own views. Thank you very much.
Sure. No, I mean, I might answer it from a slightly different perspective. I mean, my experience when I come across specifically CFAs, typically they're in the front office. There might be an advisory role. So I wouldn't necessarily see a CFA as someone who would be sort of, stepping into an ICAAP role. And again, I think MBAs, you tend to find that they're the more sort of, let's call it, higher level. And unless they come from, let's call it, an engineering or maybe a mathematics background or a physics background or a science background, you tend to find that they wouldn't have the ability to, come at the capital demand side. So looking at, say, for example, stochastic models for, market risk, looking at sort of the, the components around sort of, economic capital for credit, for example. So I think the short answer is I don't really see the sort of CFA and MBA as a sort of a competitor. I see them more in the kind of the front office, like a business role, as opposed to ICAAP, which is effectively planning, scenarios, simulation, and forecasting, which is generally more aligned, I suppose, with the actuarial skill set. So.
All right. Thank you very much, Stephen, for sharing those views. And yes, sure, there will always be other professionals, and you must expect it. But let's show the value. Show the value, and we know that we definitely have this skill. So thank you very much, Stephen. Now, there is another question here. Risk assessment, scenario and stress testing, and recovery plan, often separated from capital perspective and business continuity management perspective. From your view, would it be beneficial to work on it together on a more holistic view? So that's the question from the floor. Thank you.
Yeah, I mean, absolutely. I mean, that was kind of the final slide before we went into the summary, where I was pointing out the stress continuum from your ICAAP into your recovery planning and then into ultimately resolution planning. I think the sort of if you don't have that connection, certainly from an ICAAP, in terms of looking at those recovery options from a financial perspective and looking at, okay, what if I happen to do a sale and lease back, say, for example, of my main head office, right? What would be the impact of freeing up that capital in terms of my, common equity tier one? How would that impact on my sort of cash flow, for example? If you don't have that connectivity in terms of recovery planning and ICAAP, it's likely that your regulator would have some questions. I think, apologies, Mike, because you've removed the question. I think there was a component around business continuity planning. I mean, one of the key components as part of any recovery plan is the operational aspects in terms of how long would it take me, for example, to do a sale and lease back of, say, for example, the head office, understanding some of those operational components. So there needs to be a potential overlap in terms of business continuity. And you do see that as part of, certainly when you go into the resolution around operational continuity in resolution, but business continuity could be connected if, say, for example, there was an acute, physical event such as a flood, which sort of brought down a data center, which then impacted in terms of the execution of your bank's business model, and then the potential operational losses and the reputational damage of that. So depending on why the business continuity plan is triggered, there does need to be a connection into recovery options and potential impacts on your capital. So if you are operating in an environment where you don't have that continuity across, ICAAP recovery planning, because not necessarily all banks have a resolution plan, then you would be likely getting some questions from your auditor, and very much likely getting it from your prudential regulator as well. So, I mean, that might just be a function of your institution's, let's call it maybe less a mature approach to recovery planning and business continuity planning, or the potential perceived risk of a sort of let's call it a recovery event occurring. So,
all right. No, thank you very much, Stephen, for that. So we've got about 4 minutes to the end of time, but I've got a critical question I would like to ask, and if we still have more time, there will be one last question I'll ask. Now,
sure.
What gives rise to capital? What gives rise to capital is risks, right? So that is what gives rise to capital, if we really just want to summarize it. Now, my question is on material risk assessment. When you are conducting material risk assessment, how do actuaries ensure that risks like reputational or strategic risk, which are harder to quantify, are not underestimated compared to your credit risk or market risk? And the reason I'm asking this is very much strategic. At boards, when you sit at boards of directors, boards often really focus on pillar one risks, but the so-called soft risks that I've just mentioned can be the ones that trigger crisis. So that's why I've asked that question. What are your views?
Yeah. Well, look, I mean, reputational risk, I think, is certainly far more challenging in terms of the measurement component. I think that relates to the fact that there isn't a commonly adopted definition of what reputational risk actually covers, because obviously as a pillar two, it's not standardized. To your point, I think it's interesting. I don't know if you saw, but the US, the Federal Reserve, as part of its supervisory team, basically is now told its supervisors to not focus on reputational risk, right? And so it's no longer in the US, according to the Fed, a material risk, right? Which does seem a little bit odd, given obviously the Silicon Valley Bank, debacle in the start of 2023, where, obviously due to rising interest rates, the loss through the fair value through OCI on the government debts, which then resulted in a sort of a social media kind of frenzy. That kind of reputational impact through that kind of consequence was quite material. Now, in terms of the measurement approach, I mean, in my experience, there's two broad approaches. One is what I would describe as a scorecard approach, where the bank looks at judgmental factors such as its compliance with regulatory standards and potential fines, its corporate governance, its internal audit findings, and those kind of oversights, and then basically has a score which will then sort of put into, say, quantiles or some kind of binning, and then sort of add a sort of a subjective factor, right? Now, clearly there's a hell of a lot of subjectivity in there, but I mean, a more objective way you could look at doing an event study. So some banks will look at when they've disclosed to the market if there's been an operational loss, might be an internal fraud or some kind of trigger. When the market discloses, when the bank discloses to the market there's been an operational loss, sometimes what you'll see is that the market capitalization will drop more than the actual, the fine or the operational loss. And that spread over that operational loss can essentially be thought as a reputational loss, because if the market was rational, the drop in the market cap would only go down by as much as the operational loss, right? So you can effectively look at event studies and then measure those observed reputational losses and essentially build just a standard kind of value at risk. Now, there's obviously a hell of a lot of assumptions going into that process around when does the information actually get into the market, when is that actually priced, blah blah blah, as the usual challenges of running event studies. But that is obviously a more rational approach. But I mean, Mike, I would just say, just because something is a material risk, not all banks then hold capital for reputational risk. I mean, there's a number of institutions which I've consulted to, which will say, okay, we have a marketing spend and we have a compliance team, which essentially acts as a mitigant for that, not holding capital. So they accept it's a material risk, but because of those limitations, which I was just outlining, around the measurement of reputation risk. They don't necessarily hold a capital number. I think if you mentioned also strategic risk, I think there's lesser debate in my mind in, let's call it, larger, well-functioned banks. Effectively, you can think of strategic risk as an earning at risk type profile. So if you were to look at running a range of different scenarios in terms of different trajectories in terms of the macroeconomic, the geopolitical, and some of those sort of reputational and ESG factors, and then see how that impacts in terms of limit settings, in terms of product mix, in terms of funding mix, how that sort of impacts your earning profile. You can effectively come up with essentially an earnings at risk to which you could then set a percentile based on your risk appetite and have that as a sort of capital allocation for strategic risk. But again, I haven't necessarily seen all banks that I've worked for take that kind of earnings at risk approach. I mean, there is by definition no standardization when it comes to earnings at risk. I mean, is that kind of consistent with what you've seen, Mike, or what's your view on that kind of strategic risk? I think it's far easier to define. It's an easier sort of capital number relative to reputational risk.
Yeah. No, look, I think a lot of the issues you tend to find are really very subjective when the decision is being made. Strategic risk is one of those very difficult areas where on how to actually estimate losses. I personally haven't actually been exposed to it for me to be able to tell you, how actually it works. But it is one of those risks we know it's very difficult, and it covers a whole lot of things across the bank in many different functional areas. So it requires expert judgment for you to know, what to actually do. But but otherwise, Stephen, thank you very much. We have reached our time, but whilst we are there's a question I was going to ask. You don't have to answer it because it has been asked and answered before, but I want to emphasize it because it is quite an important question, because actuaries are definitely expanding into banking beyond traditional areas. We have been talking about this since we got to know each other for the past 11 years or so. And the question I was going to ask that has been answered earlier is that, you highlighted in your last slide opportunities for actuaries in banking. And I was going to say to you, what do you think makes actuaries uniquely positioned to bridge finance, risk, and treasury in ICAAP compared to other professionals? And I think that's what we discussed when the question came from the audience. I don't know. I don't think you have anything else to add. If you do, 30 seconds, then we close. Thank you.
No, as I say, just feel free, people on the call, to reach out via LinkedIn or whatever medium. Happy to, connect with actuaries working in the banking. As you say, Mike, it's obviously a newer field relative to the insurance sector and the pension sector. So, actuaries working in banking, it's always good to, stay connected.
Yeah, thank you very much, Stephen. Thank you very much. It's always a pleasure to have you come and present with your experience, deep technical knowledge of banking. We benefit a lot. And to the audience, thank you very much for attending this webinar. We hope that we will hold another or more webinars in the future. We will continue to do that. And please join, attend, bring along everyone else. And to Nancy Kelly, thank you very much for organizing this, for helping us in delivering this webinar. And let's hope that everyone who has joined today, you find it insightful. Otherwise, thank you very much, Stephen. Thank you. Bye. Kelly, thank you very bye.
Yes.
And everyone else,
Thank you very much.
Thank you very much.